Hello, everyone. Good afternoon, good morning. I just wanted to thank you all for your time today for joining Blueprint's webinar on our adaptive allocation models, which are available on the MWP platform. I'm Mike Carlone, Blueprint's National Sales Manager, aka Bald Guy number two. Thanks to our marketing team for that shout out. I'm joined by Bald Guy number one, John Robinson, aka Blueprint's CEO and co-founder. Before we get started, a couple of quick housekeeping items. First of all, there will be a replay of today's webinar, which we'll try and get out pretty quickly. If you have any questions, please submit those through the Q&A button, and we'll try to address those throughout the webinar and or at the end of the webinar. We're going to try and keep this at 30 minutes as we promised. We might run a few minutes over just depending on the Q&A and of course, how slowly John talks. So with that said, I'm going to turn it over to John Robinson. Go ahead, John.
Hey, thanks, Mike, for that very warm introduction. I am from the South, and Mike and the rest of our team have a stopwatch out right now as Ball Guy number one runs through these slides. And I promise to, out of respect for you and your time, do this as fast as humanly possible for me. So let's jump right in. So the four models that are available for you on the MWP platform, it's our tactical suite of strategies, and there's four models available to you. And they're the standard models that you're used to and ranked by volatility or how aggressive the client's risk profile is. And they range from growth all the way down to conservative. So nothing particularly esoteric about that. I will add, and we think this is hopefully a huge benefit to you, is that Blueprint strategies on the MWP platform are at a zero model fee. And this is because we get compensated because we use a few affiliated funds within the allocation of each model or each portfolio. And now these funds are also available as a standalone investment on the SAM or the SWIM platforms to you as well. And we think we also set ourselves apart not only by having a zero model fee, but our affiliated funds are less than half of the allocation. So, we think that sets us apart, and we hope that that helps you, particularly as you're having conversations with clients. You're getting tactical asset allocation or asset management with no explicit model manager fee on the platform. So as we dive into the characteristics or attributes of these strategies and models, there are five for us that really stand out. And I would start at a high level by saying the overall goal of all Blueprint strategies is to, number one, keep compounding at or near its highest point. And number two, smooth the ride for the clients so that they're able to realize the goals that you work with them to set, regardless of the market environment. So how we do that is, number one, all the portfolios are globally allocated. We use 8 different asset classes to do that. We'll get into more about what those are. Those asset classes are driven by a rules-based process that we have optimized for behavioral finance. So what does that mean? Well, when we think about behavioral finance, it's really a two-way street. On the one hand, it's rules-based, which keeps us, the manager, disciplined, and our rules are transparent. So you can hold us accountable to do exactly what those rules say we're going to do. The second part of that is to keep the client in their seats during periods of high volatility and downtrends or compound killing markets. And so by trying to smooth the ride with our tactics driven by trend following strategies, we feel like that even more optimizes the portfolios for behavioral finance. So in doing so, the models move in a dynamic way. So the dynamic adjustments are dictated by trend following strategies over the long term and intermediate term. And we're really responding to market changes at all times with the focus on downside protection. That's part of keeping compounding at or near its highest point. On the one hand, you have a brake pedal to slow the ride down as trends are falling. And on the other hand, we have a gas pedal as trends are rising to be opportunistic in the market. And all of this is done in a very tax aware way. And this is through what we think of as implicit tax loss harvesting and explicit tax loss harvesting, with really the implicit loss harvesting being the highest magnitude benefit, whereas where trend following is constantly cutting losses, harvesting short-term losses, and then by and large letting winners ride at least to long-term capital gains rate. So if you have non-qualified accounts, it's been our history and our track record to show that while the strategies we can't say are tax friendly necessarily or optimal, they are in most cases at worst tax neutral. So being rules based means in a trend following way where we're reactive means that we are adaptable. And by being adaptable, that means that we know where the model is likely to be positioned depending on the market environment. So what you see here are 4 different market environments we faced in the last 10 years. And right now we're really in quadrant 3, and that's the equities are falling, volatility is increasing, and you see a pie chart here, which is a representation of how we would be positioned in a market environment like that. And so right now, trends are falling in the US, so we're very defensive in the US, but we are overweight foreign stocks, and we'll get into that more later. We're also overweight fixed income, both in the intermediate term and the short term, with a healthy allocation to alternatives. And this is both alternatives in the classic sense to provide non-correlation, but also in a hedged equity component in the portfolio to represent US equities in a downtrending environment. Now, I say all this to also end with, at least for this slide, that we're ready to reposition as markets dictate. So as one of these market environments changes or shifts to another quadrant, if you will, Blueprint is ready to adapt as price dictates to us, and therefore the trends dictate that volatility is reduced and the trend is now emerged to the upside. So practically speaking, every Blueprint strategy is governed by 2 macro pieces that break down into 3 component parts. So the macro pieces are a buy and hold component and a tactical component. And I've already mentioned several times already, and we're 5 or 6 minutes in, that the tactical component is driven by trend following over 2 time frames. That's the intermediate term and the long term. And we're fully transparent and rules-based. There's no black box here. So we'll tell you exactly what those rules are so you can know, and again, as I said before, hold us accountable to make sure that we're executing the strategy that that you're paying us to execute. On the other side of that is a buy and hold piece. We call that a strategic piece. What this means practically is that the strategies are not binary, which means we don't move from all-in equities to all-in cash. We're very deliberate in how we slice up risk. So we're stepping into risk and stepping away from risk over multiple timeframes. But the minimum value that we're going to hold because of the strategic piece is greater than 0. So even when there are downtrends that have emerged in, let's say, US stocks right now, we're not going to go from 60 or 65% US stocks to 0. The min value in US stocks for us is around 13%. So we're going to sell down to that level. And we really do that for behavioral reasons so that you're not put in a position to have a tough conversation when the client feels like they're missing out on a run after a bottom happens and the trend following has us defensively positioned.
Just to hop in real quick, this question asks, what systems and signals do you use for allocation and position decisions?
Yeah, this is great. People are really paying attention. I like this. The systems we use are based on moving averages in order to measure the trend. So when I talk about the 2 time frames, intermediate term trend, long-term trend, we define the intermediate term trend as the using 2 different moving averages, the 10-day and their exponential moving averages, the 10-day and the 100-day. So we measure those on a daily basis, but we only react to them monthly. So you've got if 10 above 100, rising trend, if 10 below the 100, falling trend in the intermediate term. On the long-term side, it's the same moving average calculation. We're just using longer term averages. So we got a 50-day and a 200-day. Again, measuring that daily, reacting monthly. So if the 50 is above the 200, we'll define that as a long-term uptrend. 50 below the 200, we define that as a long-term downtrend.
Straightforward. Okay. Yep.
So when you take a look at a client's account, let's say you're in a Blueprint tactical growth strategy, you log into your system and you look, you're going to see by and large 8 asset classes. And we've intentionally designed the portfolios to be not scary and not esoteric in nature. We want them to look and feel the same as what the client is otherwise used to in a passive strategy or an asset allocation strategy. But then we overlay the trend following onto that, which governs how the asset allocation moves around on a monthly basis. And so you can see there are US equities, foreign equities, emerging, and real estate. That's the equity bucket. And then we use government bonds of all durations, inflation protected securities, global bonds, and alternatives to round that out for non-correlation.
Hey, John, let me just hop in here real quick. Looks like we have a question that popped up on the previous slide. This question says, I've noticed that individual equities are listed on the asset class slide in some of the boxes that you had up. Do you own individual equities in the models?
Oh yeah, it's a good question. So we don't own them in the managed account itself. So if you look at the portfolio, like I said, and you were to log into your system and see the holdings, you wouldn't see individual equities. And there's a specific reason for that. One of the affiliated funds that we use, that we manage, is comprised mostly of individual stocks. And so in order to solve the problem of getting individual stock exposure in each account while trying to neutralize account size, because that's the greatest enemy to individual stocks. If we want to use a couple of hundred individual stocks and trend follow them, account size becomes an issue. And we want to make sure that your $50,000 account gets treated just like a $5 million account does in terms of the exposure and its ability to be exposed to trend following across a wide range of stocks. So the individual stock piece on the MWP platform, it's there. It's just wrapped in one of our affiliated funds. But so what does that mean? Well, we're taking several hundred stocks. We take the S&P 100. We take a foreign developed index. We use emerging markets, and we try to break them down into the smallest component pieces we can, which is typically the individual stock level. And then we apply the same rules to those, shifting allocation based on the intermediate term and the long term, and with the attempt of getting as close to the ground as possible with each component. But not only that, what we think is the closer to the ground we get, so to speak, the more influence that trend following has over the portfolio.
Good. Yeah. Good to kind of stress test that.
So again, going back to being rules-based and having portfolios that are designed to be not scary or not esoteric. What the slide here is showing you is that because we're rules-based, we know how we're going to be positioned, or likely how we'll be positioned, depending on where the trend is at any one time. So we know if the trends are rising over all time frames that we measure, that the portfolio is going to be about 85% stocks, 10% fixed income, and 5% alts. That's the baseline for our tactical growth strategy, for example. But if the markets react in a particular way based on trend, we know how we're going to reduce exposure or add exposure. So I just bring your attention to the minimum exposure. So in a 2008 scenario, a prolonged bear market scenario, a corona crash scenario, our 85-15 baseline can go all the way down to about 20% stocks and 80% fixed income and alternatives. So the importance of this to you, we believe, as the advisor, is this gives you transparency and visibility to what the strategy is capable of. And what we're really attempting to do is make sure that there are no surprises on your end, especially when you're trying to articulate the goals of the strategy and where it might be positioned going into next month or thereafter. So this is another part of behavioral optimization, where the transparency and the visibility to the client hopefully allows them to sit in their seat in more challenging market environments where And that typically shows up as stocks are falling and volatility is increasing.
John, another question here just came in. Says, I noticed alternatives are listed at about 5%, and that seems a little bit low. Can you talk about that a little bit further?
Yeah. Well, I think it depends on, I'm not trying to be coy with this answer with the audience here, but I think it depends on what your definition of alternatives are. When we say alternatives, what we're really talking about is something that is designed to provide non or negative correlation over long periods of time. So the exposure we use right now is a quasi-managed futures with a long-short equity component in one fund. If you had a more broad definition of alternatives, which is totally fair, then we have a larger allocation because, as I mentioned earlier, we use hedged equity, which on many platforms, by many definitions, is considered an alternative because they use options to hedge the downside risk. So the inclusion of derivatives makes them, by some people and using some definitions, an alternative. And in the affiliated fund that I mentioned earlier, where we use individual stocks, we also use gold in that portfolio, as well as the VIX. So as part of our risk management system, intra-month, so the only component of our entire process that has an intra-month signal, if you will, is a VIX strategy we use inside that same affiliated fund. And that's really intended to try to put on the brakes, apply the brakes a little harder intra-month before a trend shift occurs, to slow the pace of downside volatility, which would then come off as took us out of that exposure.
Hey, John, thanks for that. You cut out for just like a brief second or two there, but I think we got the core of your answer. So thank you for that.
So a big component in something we think sets us apart, so a big component of our portfolio management style is what we call the risk handoff strategy. And, to the chagrin of Mike and team, I could go into this for a couple of hours, but I committed to not doing that. So we're happy to do that with you on a one-on-one or on a group basis anytime you want. But the real key to not only the risk handoff strategy, but how this shows up in a client portfolio on a monthly basis is number one, we don't just run to cash. So you see here a grid or a gauntlet, if you will, of the asset classes that we use that we just talked about before, ranked based on their historic volatility. You could also say that they're ranked on their expected return, but for us, it's about volatility. So you have emerging markets, for example, on the left side. So as a quick example, when emerging markets goes into a downtrend over one of the timeframes that we monitor on a systematic basis, our strategy is going to say, okay, first principle is we take that exposure off. But then it's going to go to foreign developed equities and ask the question, are foreign developed equities in a rising or falling trend over the same time frame that emerging is reducing exposure? And if the answer is yes, it's in a rising trend, then we pull the exposure from emerging and then put it in foreign developed. And now we're overweight foreign developed. And then this is actually exactly the scenario that we're in right now. Emerging markets is in downtrends over both timeframes that we look at. Foreign developed is in rising trends. So we've got some decoupling or some non-correlation there, divergence. So what we are is we are underweight at minimum allocation to emerging markets, and we're overweight foreign developed, not because we have a macro call, not because we're being discretionary or we're making a prediction. We're simply doing what we do best, reacting to the trend. We're reacting to what the market is doing. And therefore, we're now overweight foreign developed equities and underweight emerging. And that's being driven by a systematic process. So let's review how the systematic process is done. And, back to 2018, which is when this graph starts, we've been through several different market environments. We've been through the decline, and you see the three largest drawdowns here on the screen. We've been through December of 2018, we've been through the Corona crash, and we've been through the bear market, if you will, of 2022. And the context around each of those declines is different. The speed in which they declined are different. And yet, because our systems are designed to be robust and not tied to any one specific market environment and are simply just looking at the intermediate term and long-term trends, we were able to protect capital and reduce equity exposure in all three environments at varying speeds and with completely different context. So you can see here on the left side of the graph, we were at our minimum exposure to equities or heavily reduced in a defensive posture in December of 18. So we're able to somewhat fly over that volatility like we were during the Corona crash, which started in February of 2020 and extended through March of 20 before it V-bottomed and then made the largest recovery after the largest drop and fastest drop in market history. What you don't see here is April of 25. And the reason for that is most of that volatility and most of that drawdown occurred on an intra-month basis. However, we had reduced exposure going into April from March, and we're able to not bypass all the volatility, and we're not trying to bypass all the volatility. But for example, when the market was down at its worst, roughly 21%, we were about half of that on a drawdown basis before the market started to recover and technical growth started to recover. And then coming into May, we cut even more risk on that front. So let's talk about that now. So for May, how have we been positioned for May? Well, the trend over the intermediate and long term in U.S. stocks coming into May was down. No surprises there. So we are underweight U.S. stocks. We are not at our minimum allocation, and that's being expressed by a market cap weighted position and a hedged equity position. Foreign developed is at its max allocation because it's seeing rising trends over both timeframes. Emerging, as I've talked about before, the handoff between foreign developed and emerging's in its minimum allocation, as is real estate, because over both timeframes, their trends are down. Now, in fixed income, we've increased our bond duration risk, particularly in the intermediate term, which according to our models and the way we look at trends is the strongest piece or the strongest part of the yield curve right now. So intermediate term bonds have resumed a rising trend as they continue to recover from their bear market, which started in late 21 and extended to now. And so we've taken capital from the ultra short-term and short-term duration bonds and just simply started stepping it up in duration to get more volatility from the bond piece, which at least recently has acted as somewhat of a hedge to declining stocks. So with that, Mike, I hope that I was able to honor your commitment for us doing this in roughly a half an hour. And I don't know if any more questions have come in, but if they have, we can go over those now.
Cool. Well, John, a few more questions came in, and I'll just kind of run through these here real quick. Let me see. So, are you using any proprietary holdings in the model? Actually, I think we addressed that one already earlier. So the answer is yes. We do use some proprietary or affiliated holdings, but as John mentioned, we are, to our knowledge, unique in the sense that we are not 100% affiliated holdings in the models. But feel free to reach out for additional color around that. The next question that's here are monthly adjustments that you're making, or is that trading too slowly? Are you not adapting too quickly? So go ahead, John, if you want to tackle that one.
Yeah, that's a good question, and one we get quite a bit. So the way I would answer that is, so our track record goes back to 2013. It's GIPS verified, but the data work we've done goes back to, well, 1790, but really the best daily data we have goes back to 1900. And when we test these strategies over all the asset classes we use in real time and all the asset classes that we don't incorporate into the portfolio, by and large, it is more optimal to execute these strategies, picking up the data daily. So you're measuring daily, but you're only reacting monthly. So from a data perspective, it's just more optimal to do. Practically speaking, if we were to execute on a daily basis, you'd have more turnover, which would result in more realized gains. And so, part of the behavioral aspect of our strategies is making sure that, or trying to minimize the number of tough conversations that the advisor and the client have as a result of a blueprint strategy. So minimizing the number of trades, minimizing turnover, the noise that could create with the client, and therefore minimizing taxes. When you combine that with the more optimal approach to executing monthly that the data points to, we just feel like it's far more optimal to do, even though you may have some discomfort intra-month. What we found is in real time and in the data is that it pays to force the trend to be persistent and wait until the end of the month to react.
Okay, everyone. Well, that's about it for us. We're really grateful for your time. Thank you for the opportunity. If you have any questions, well, first of all, if you want more information, go to blueprintip.com as you see there on the screen. Or you can email me directly at mike.carlone@blueprintip.com. And again, thank you for your time. We appreciate it.